Hello there, Prof. Aram here, and in this video we're going to look at the signaling theory of the capital structure. So let's get to this. If you remember, Modigliani and Miller assumed that investors and managers have access to the same set of information. They assumed symmetric information. But in reality, most of the times, insiders of the firm, the managers, have significantly more information, have access to better information, not just more information, compared to the outsiders of the firm. We call this an asymmetric information situation. In this case, since managers have better information, they would sell stocks if the stock is overvalued, and they would sell bonds if the stocks are undervalued. And investors understand this, so view the new stock issuance as a negative signal. So what is the implication for the managers? Consider two scenarios, one of which the company's managers know that the prospects are extremely positive, and in the other one, the managers know that the future looks negative. So we call the first one firm P for positive outlook, and the second one firm N for negative outlook. So how should the firm's P management raise the needed capital, and how should the firm N's managers raise the needed capital? So for example, let's say firm P is a pharmaceutical company and they have some expectation that their new drug is going to be approved by the FDA. So it's a very positive outlook. Suppose firm P's managers issue stocks. When the profits from the new product starts flowing in, the price of the stock would rise sharply and the purchasers of the new stock would make a windfall. And the current stockholders, including the managers, would also see an increase in the price of the share, but not as well as they would have done if the company had not sold the stocks before the price increased. Because then they would not have to share the benefits of the new drug with the new shareholders. Therefore, we should expect a firm with a very positive prospect to avoid selling stocks, instead to raise required new capital by other means, including debt. And even if the debt is beyond the target capital structure, that's fine here, because you don't want to share the upside with the new shareholders. Keep in mind, with debt, the interest expense is fixed. So all bondholders want is to receive their coupons and principal. As shareholders, as managers, you don't have to share the upside of this positive outlook with your bondholders. In other words, the shareholders and the managers get to keep the upside in this scenario by issuing debt, instead of sharing the upside by the new shareholders if they issue equity. Now let's consider firm N with a negative outlook. Managers have information about the lower sales and other problems within the firm. Firm N must upgrade its own facilities at a high cost just to maintain its current sales. As a result, its return on investment will fall, but not as much as if they took no action, which would lead to 100% loss through bankruptcy. How should the firm N raise the needed capital? A firm with negative prospects would want to sell stocks, which would mean bringing in new investors to share the losses. Keep in mind, for firm N, if they issue debt, they're going to increase their fixed cost. So this is the fixed cost, interest expenses, fixed costs that they have to pay. And the higher the fixed cost, the higher the risk of the business. Since they are in a precarious situation, they don't want to increase the fixed cost of the company. They don't want to increase the risk of the company. So that's why firm N would choose to issue equity in this case, because they want to share losses with the new shareholders in this case. So the conclusion is that Firms with extremely bright prospects prefer not to finance through new stock offerings, whereas firms with poor prospects like to finance with outside equity. And keep in mind that firm and manager cannot make a false signal to investors by mimicking firm P's and issuing debt. In other words, they cannot really bluff the investors here, because with its unfavorable future prospects, issuing debt could soon force firm N into bankruptcy, and given the resulting damage to the personal wealth and the reputation of the firm's N managers, they cannot afford to mimic or bluff the shareholders and mimic the firm P's actions. All of that suggests that when a firm announces new stock offering, more often than not, the price of the stock will decline. Empirical studies show that when the companies issue new equity, they usually see a drop in the return in those investments. I hope you find this video useful, and thanks for watching.